being in the right stocks will mean more than just being in stocks. Steve, talk to me about that, the importance of that.
Yeah, what we have thought, Jonathan, is that, as this market has unfolded with this crisis, what we're really seeing is that, the trends that were already in place for the last several years leading into this are now just simply accelerating. And the winners are benefiting from, the digitization of the economy, the biotech revolution, the industrial renaissance in the U.S., all these trends that have been moving stocks around and separating the winners from the losers in a kind of gradual fashion are now accelerating. And the market has almost become bifurcated. And the problem is too many people are looking at the market average and scratching their head saying it's detached from economic reality, when really you've got to look at the economically sensitive names. They're what I call the survivors more than the winners. The winners are gaining market share. They're improving cash flow. I mean, Amazon, 25% expansion in sales last quarter. Do you really want it to retest the March lows when it looked like the world was going to end? It doesn't make sense. And that's what's keeping the average higher. But last week, we had a major retest of the March lows in the economically sensitives and what I call the survivors. You go down at stock by stock. We were talking in the break about J.P. Morgan, an example of a big financial. Intraday on Thursday was at 82. It closed in March at 79 at its very low point. 3M in industrial space, intraday was at 131 last week. It traded mostly in the mid-120s, really. It touched 118 back on March 23rd, but was trading in the mid-120s. Exxon, clearly a survivor here, right? Especially as the oil market starts to tighten up, throwing off a nice, healthy dividend. I mean, not the growth stock of the future, but it's going to be paying those dividends. And the stock got down to 40 last week. It was trading mostly in the mid-30s in the dark days of March. And I'd even point to what I call the high debt survivors. I mean, the market's been worried about these big players that have a lot of debt with a lot of cash flow, like an AT&T, which is a company that we like. It's got an enormous amount of cash flow. The debt's covered 5 times. The dividend's covered twice. But it's got a lot of debt. That stock came right back to the March lows last Thursday, right down there around $28. So I would say that the market's not detached from economic reality. You know from your discussions with me over the program that we're a little more constructive on the economic reality. We're not calling for a V. We think it's going to be a very choppy restart, but we do think we're going to get restarted and move forward, and every day is going to be a little bit better than the last. But more importantly, the market is not detached. It's worried about the economic reality. We think it'll start to get better as we move forward. But in the meantime, the real game here, I think, is in this winners and losers game that's emerging.
Well, let's talk about it, Steve, because I think it's really important. I've made the point over the last several weeks that the likes of Netflix aren't up this year 30-40% because people expect a V-shaped recovery. The banks are down about 40% this year because so many people do not. The trade that many people are itching to make in this very moment but just don't have the confidence to do it is the cyclical rotation. And it just all adds up. In the next several months, you get that nice sequential month-on-month improvement. The hope starts to kick in. The data starts to move the other way. We know the positioning story. It's really quite evident. And you can see how a squeeze can come together. But then you get people like you, Steve, that are basically saying the big get bigger. And when people say the big get bigger, I'm thinking of sticking with the big growthy tech names in a low-growth, low-rate world. I'm thinking of the mega caps. So how do you reconcile those two things? The big getting bigger and a rotation into the cyclical space, away from that?
Well, we've already priced in the big getting bigger. And, for the long haul, we continue to like many of those names, Jonathan. But it is a misnomer to say it's just the big getting bigger. I mean, actually, although the broader market doesn't look like it's doing that well, within it, there are a lot of winners in the small and mid-cap space. In fact, our small and mid-cap funds are the ones that are doing the best right now. which is hard to believe, but we've been focusing on winners. And within small cap land, there's plenty of companies in tech, in biotech, even industrials that are actually doing quite well, both domestically and internationally. And, like as an example, our small cap growth fund is up 3% year to date. So it's not the case that only the large cap stocks are doing well here. I think the winners and losers game is broader going out through the economy. But to get to the heart of your real question is, when do you make the switch into the cyclicals? And there, I don't think it's a winner take, it's a all rising tide lifts all boats kind of environment there. I think you've got to be selective and picky. So our view has been, let's start sniffing around here and pick the very best of the group. We don't think you have to pick the dogs to win that game and to do well in those stocks. But we're not recommending people load up on those names. I think you've got to be very selective.
Steve, just before I let you go, just in the couple of minutes we have left, if you're having tremendous success at the small cap level, it's a lonely space to have that success because so many people have struggled over the last month there. They've really lagged. Both on the way down, they've suffered. On the way back, they have barely moved. Where are you having success in small cap land? Can you get more specific on where you're having that kind of success?
Well, I don't want to talk about specific names, Jonathan, because we do have a lot of money coming into those funds, and we're buying the stocks every day. So it's hard for me to talk about specific names, but people can look at our Kaufman Small Cap Fund or our International Small Cap Fund and see the names we own there. But we're having success broadly within industries, and certainly heavily on the tech and pharma side. But not just there. There's actually, within the broader economy, there's a lot of companies that are making use of these trends towards digitization to improve their own positions, including, as an example, in retail, right? And even in the restaurant business, there's companies that are doing much better than others. So it's just not as broad, a trend as you'd think. You've really got to look at the individual securities. And, I get it that a lot of people are struggling in those spaces, and the indices are not doing well. But our funds are, I don't want to quote specific performance. You can look it up, but it's unbelievable almost, frankly. But it's a very dramatic environment right now.